This video considers now the change in the unguaranteed residual value of Matty Collector Limited for the year 31 December 2013. In the first four videos, that unguaranteed residual value had been set at 40,000 Rand, and now the management of Matty Collector on 1 January 2013 have revised this estimate downwards to 8,000 Rand. So you would have set up your first balances at the end of 20x12 in the first four videos of this series, and in part B that we'd been looking at in that instance of this question. Now, in essence, what happens with an unguaranteed residual value, when it changes, you need to basically go back and to redo all your calculations to see what your balances would be now if this estimate had been made initially. So in the first four videos, you have calculations based on an estimated unguaranteed residual value of 40,000 Rand. You did your journal entries, and that was all dealt with in the first four videos. Now you need to reposition yourself and essentially go back and redo those calculations from the first four videos, but now using the unguaranteed residual value of 8,000 Rand. So briefly just considering what was done in the first four videos, here are the journal entries for 20x12 that was done with an estimated unguaranteed residual value of 40,000. And that is obviously now included in the gross investment, the 320,000 Rand. Please refer back to video 1 to 4 if you need clarity on that. But essentially what happened was the machine was sold, you transferred your cost out, you transferred your accumulated depreciation out, your profit on sale, you now have the carrying amount just above of your assets. The fair value at the date of sale was given as 200,000 Rand, allowing you to calculate this profit. And then instead of receiving a bank amount, this was basically sold on credit as a loan in the form of a finance lease, with our peculiar circumstances in South Africa of accounting for this in these two accounts, the gross investment and the unearned finance income. And the unearned finance income, which you'll also remember from the first of the four videos that precede this, is influenced by the amount of direct costs, as was explained in video 4. Please refer back if you need to see that. Then you had your payments at the end of 20x12 of 50,000 Rand, which went against the gross investment, given that it's the capital and the interest which we recorded up front, and needs to reduce that. And then we realized some of that unearned finance income now at the end of 20x12, and we essentially unwind that out of unearned finance income to profit and loss. So what you'll need to do now, if there's an unguaranteed residual value, you'll need to reconsider all these amounts, because these amounts now will form your ledger balances at the end of 20x12. And what you need to know is what will these balances have been should you have done it with the revised estimates from the beginning of this economic events accounting. So looking at how that change now would affect these journal entries, well, the 192,000, the cost of the asset that you're disposing doesn't change. The accumulated depreciation for that asset doesn't change. The fair value of 200,000 remains unchanged, so your profit would still be the 80,000 Rand. The direct costs remain unchanged at 2,000 Rand. What does, however, change now is this gross investment in the finance lease, because now your residual value had been included at 40,000 when you calculated it. So remembering it's the 5 payments of 50,000 plus the unguaranteed residual value and the guaranteed residual value, which was 40 and 30 respectively. So now instead of having the 40 unguaranteed, you only have the 8,000. So your gross investment in the finance lease has dropped because of this change in estimate. So if you calculate it again now, you'll be looking at 288,000. How did I calculate that? Well, it's the 50,000 payments for 5 years. It's the guaranteed residual value of 30,000 Rand, and now the unguaranteed residual value of 8,000 Rand. That would give you now the total payments that you're expecting to receive on this lease, which is the 288,000 Rand. And then as a consequence of your values changing in your calculation, again, the interest is going to change again. So your balancing figure now in this journal would be the unearned finance income again, which would be an 86,000 Rand initial balance now at initial recognition, which is equal to the drop in the payments value. Given that, I mean, your principal, your proceeds are staying the same, your direct costs have stayed the same, being 200,000 and the 2,000. The 50,000s have all changed, stayed the same. The payments, your residual values you now have in there. So interest again needs to be the balancing figure, and that drops down to the 86,000 from the 118 that it would have been at. So there you're able to see the effect on the initial recognition journal if it had always been done with the revised estimate. Now in your subsequent recognition, the 50,000 gross investment, that remains unchanged. That payment will occur at the end of 2012. So even if you had known this estimate initially, this stays the same. You'll now have to, though, redo your amortization calculation, because you're going to be working on that smaller future value, taking into account only the revised 8,000 residual value together with the guaranteed residual value of 30,000. So put that in your calculator, do your amortization function, and you're going to get a new interest amount coming out from that of 24166. Now you basically have the picture on the screen of how these journal entries were done, given the actual estimate that was used of 40,000, and what they would have looked like if that estimate had changed. Essentially, these columns on the right-hand side is revision of what we did in the first 4 videos. The only difference being that we've used a slightly different future value now, because we used the unguaranteed residual value of 8,000 instead of 40,000. So I will pause this video at this point and move on to the next video, but make sure you use this as a revision exercise, because the change in the residual value, the effect now will just be the difference between these 2 columns. And we'll do that now in the third video.